Brad, you just heard Robert Frank's report. How much can we read into the New York City dynamics as being indicative of other major metros across America?
I don't think very much. I think when we look at the national figures, we want to take those as national figures. New York is a beast of its own. It's certainly an area where we can hear some interesting anecdotes about some of the extremes related to the COVID dynamic. But when we look at the national figures, I think we're looking at slightly different trends.
What trends are those then?
Well, that's to say, I think while there is a trend to the suburbs generally, it's clearly more pronounced in New York just through the anecdotal evidence. At the same time, we definitely can't take New York as a beast of its own, or we should take it as a beast of its own in the sense that New York loses about 200,000 migrants a year. That's replaced by about 100,000 immigrants. If you look at metros across the Sun Belt, you're looking at net in-migration, and you're looking at net in-migration that's been rather strong for quite some time.
All right. Let's talk a little bit about the current financial dynamic that's playing out, because it's a huge driver for a lot of these purchase decisions and perhaps refinance decisions. Interest rates as they stand right now. Are we talking about a bottoming process in place? Should people be trying to refinance right now? Is there a prospect for higher rates down the line? Because that could put a damper on some of these sale prices.
Yes, definitely. Our models indicate that there's certainly potential for the 10-year interest rate to increase after the elections. And of course, that is likely to take mortgage rates with it. So in that case, once the political uncertainty of the election process has been removed, we would expect to see a reduction on the margin of mortgage affordability. So in that sense, yes, we do expect to see slightly higher mortgage rates and therefore a channeling of demand to multifamily. The Mortgage Bankers Association report on mortgage applications actually mentions this as well. They talk about the effect of low interest rates. While they're great in the beginning, if they don't continue to fall, if there's not another notable decline in mortgage rates, then you tend to see a flattening off of activity, particularly on the refinance side.
Brad, I'm a homeowner myself. I'm living the American dream, saddled with thousands and thousands of dollars worth of debt that's going to take me years to pay off, just like millions of Americans. But the home equity in my home is growing. Will that at some point lead me and lead others to tap into that home equity, spend a little bit more, and could that be a crux for moving the overall economy in America higher?
It's possible, but we have to remember from the tax reform bill that the interest that you would pay on something like a home equity loan is now only deductible if you're using it to improve the house. So I don't think we're going to see the kind of consumption that's generated by harvesting home equity as we had during the housing bubble. At the same time, there's certainly opportunity for plenty of folks to access that equity to improve their home or to even use it for consumption, just knowing that deduction isn't there anymore.